Every market crash in history created a new wave of millionaires. Here's how they did it. Here's a fact that should change the way you see investing. Every single major market crash in the last 100 years has been followed by a full recovery, and then new all-time highs. Every single one. The crash of 1929, the dot-com bubble of 2000, the financial crisis of 2008, the pandemic crash of 2020. Every time the market came back, every time the investors who held on, or better yet, kept buying, came out ahead. So why do most people lose money in crashes? Because fear overrides strategy. And today, I'm going to give you the strategy that overrides fear. Section 1. Why crashes feel dangerous but create opportunity. Let me ask you something. If your favorite store announced a 50% off sale on everything, would you panic? Or would you grab a shopping cart? You'd shop, obviously. But when the stock market drops 50%, people panic. They sell, they run. And in doing so, they lock in their losses and hand their upside to the investors who stayed calm. Here's the key insight. A market crash doesn't destroy value, it reprices it. The underlying businesses don't disappear overnight. Apple still sells phones. Johnson & Johnson still makes medicine. Amazon still ships packages. The companies are still there. The prices are just temporarily cheaper. That's the opportunity. The challenge is emotional. When everyone around you is saying the economy is collapsing, it takes discipline to say this is a buying opportunity. That discipline is the difference between average investors and wealthy ones. Section 2. The crash strategy step by step. Let me walk you through the actual strategy. There are 4 components. Component 1. You build a cash reserve before the crash. The biggest mistake investors make is being fully invested when a crash hits. They have no dry powder, no cash available to buy more. The crash strategy starts before the crash. You keep a portion of your portfolio. I recommend somewhere between 10 and 20% in cash or short-term bonds at all times. This is your war chest. Component 2. You define your target companies in advance. During a crash is not the time to research. You should already know which companies or funds you want to own more of. Make a watch list right now. What are the 5 to 10 investments you'd buy more of if they were 30% cheaper? Write them down. Have your list ready. Component 3. You deploy capital in tranches, not all at once. When the crash happens, don't dump your entire cash reserve in on day one. Markets often keep falling after the initial drop. Instead, you deploy in tranches, maybe 25% of your war chest in the first major drop, another 25% if it drops further, and so on. This averages down your cost without trying to time the exact bottom. This is also called dollar cost averaging, and the financial calculator tool linked in the description can help you model exactly what this looks like over time. Component 4. You hold or you hold longer. Once you've bought, your job is to hold, not for months, for years, possibly for decades. The compounding power of buying great assets at discounted prices and holding them through the recovery is one of the most powerful wealth-building tools in existence. Warren Buffett has used this strategy his entire career. So has every other legendary long-term investor. Section 3. What to buy during a crash. Now let's talk about what to actually buy. Because not everything is worth buying at a discount. For most investors, the answer is simple: broad index funds. An S&P 500 index fund gives you exposure to 500 of the largest companies in America in a single purchase. When the market crashes, you're buying all 500 at once at a discount, and historically, that has always recovered. For more sophisticated investors, individual stocks of companies with strong balance sheets, low debt, and durable competitive advantages, what Warren Buffett calls economic moats, are compelling crash-time purchases. A deep dive into this thinking is available in The Intelligent Investor by Benjamin Graham, arguably the greatest investing book ever written. It's linked in the description and I highly recommend it. Section 4, The Psychological Challenge and How to Beat It. Let me be honest with you, knowing the strategy is easy. Executing it when the market is down 40% and financial news anchors are predicting the end of the economy, that's hard. Here's how to make it easier. First, automate what you can. Set up automatic monthly investments. When the market drops, your automatic investment buys more shares for the same dollar amount. Your dollar cost averaging on autopilot without having to make an emotional decision. Second, limit your media consumption during crashes. Financial news is designed to keep you engaged through fear. The more you watch, the more fear you absorb. Log off, trust your strategy. Third, zoom out. Pull up a 100-year chart of the stock market. Find the crashes. Notice that they're barely visible dips on a chart that goes relentlessly upward over time. That's the context you need to hold during a crash. Tony Robbins covers this mindset shift masterfully in Money, Master the Game. It's one of the most powerful books on investing psychology ever written. Grab a copy using the link in the description. Section 5, Building Your Crash-Ready Portfolio. Here's your action plan for becoming crash-ready. Step 1, open your investment accounts and calculate what percentage you currently hold in cash or equivalents. If it's below 10%, start building toward that number. Step 2, create your watch list. 5 to 10 investments you'd buy more of at a discount. Write them down today. Step 3, set up automatic monthly contributions if you haven't already. Even $50 a month builds the habit and gives you market exposure. Step 4, read one good book on investing strategy. The Intelligent Investor and Rich Dads Who Took My Money, both linked below, will rewire how you see markets and money. Step 5, when the next crash comes, and it will come, pull out your watch list, deploy your war chest in tranches and hold. That's it. That's the strategy that makes millionaires. Let's wrap it up. The investors who get rich from market crashes aren't geniuses. They're not lucky, they're prepared. They have a plan, they have the cash ready, and they have the emotional discipline to act when everyone else is running. That can be you. The next crash is an opportunity in disguise, and now you know exactly how to use it. Drop a comment below. Are you currently crash ready? Do you have a watch list and a war chest? Let me know where you are in the process. That's Wealth Mode. If this video was helpful, please click the subscribe button and then like and share with your family and friends.